Welcome to Global Tax Talk. I'm Ege Berber. I'm joined by my co-hosts, Chloe Fox and Giorgia Maffini in London. Welcome, Chloe and Giorgia. Today, we would like to focus on several developments surrounding Pillar 2, a topic that continues to dominate the global tax policy landscape. We are starting to see an interesting turn of events with respect to the enactment of legislation by jurisdictions around the world. Some countries are choosing to defer or not pursue the enactment of the under-taxed profits rule, or the UTPR, which enables a jurisdiction to increase taxes on a business if they pay less than the 15% proposed global minimum tax in another jurisdiction. Chloe, do you expect this trend to continue, and are companies changing their action plans as a result?
Thanks, Ege. I would tend to categorise what we're seeing at the moment as a bit of a wait-and-see approach being adopted by countries with regards to the UTPR. No country really wants to be the one to stick their head above the parapet at the moment and, seek taxing rights to profits over which that country essentially has no connection. So we are seeing, a slight hesitation there for countries to introduce the UTPR, certainly before 2025. Now, obviously, some countries have legislated for the UTPR as part of the legislation used to introduce their IIR and their QDMTT. But certainly that hesitation is creeping in within the last couple of months. And maybe the best way to bring this to life is to give a couple of examples. So the obvious example here is South Korea. So South Korea had intended to bring in their UTPR from 1 January 2024, but before the end of 2023, they performed a bit of a U-turn and decided to push out their UTPR to 1 January 2025. We've also then got Switzerland, who have implemented a QDMTT to protect the domestic tax base, but they have decided not to bring in an IIR or a UTPR. Then we've also got Barbados, which has taken a slightly different approach again and introduced what we call a defensive QDMTT. So I suppose what makes it defensive? Well, if the group's ultimate parent entity is headquartered in a jurisdiction that has not introduced an IIR or a UTPR, or the Bayesian entity is not subject to an IIR or a UTPR further up the chain, then the Barbados QDMTT does not apply, and the usual corporate tax rate of between 1% and 5.5% applies as normal. So what does this mean for businesses? Well, certainly we are saying that this is creating a lot of confusion for the business community with regard to the different dates for the IIR, the UTPR, the QDMTT, which is the domestic top-up tax that countries can introduce. And then there's obviously the DSTs, which are popping up globally. So businesses need to be really careful in terms of planning out the dates from which these different collection mechanisms apply. We do still see businesses are modelling out the impact of Pillar 2, and they are still working to put together the processes and the frameworks that are needed for it, both in terms of data collection and preparing their timeline. But I suppose the key point here is that businesses do need to take that extra bit of care in terms of the different dates that can apply for the different collection mechanisms.
The OECD released guidance at the end of 2023 that addressed several Pillar 2 issues, including the transitional country-by-country reporting safe harbor that many multinationals plan to rely upon to simplify Pillar 2 compliance. Giorgia, would you please provide us with a few insights about how this safe harbor changed and how companies are responding?
Thank you, Ege. So the country-by-country report Safe Harbor was introduced to simplify the compliance process for Pillar 2 for the first 3 years of the regime. The simplification effort clearly implies that the rules for the Safe Harbor and the data used there are simpler than the rules used for the full calculations of Pillar 2. They are different. And the new OECD guidance seems to effectively try and reduce these differences by providing effectively more restrictions on what constitutes a qualified country-by-country report. For example, despite being really a common issue for taxpayers, post-year-end adjustments, for example, transfer pricing adjustments, are not permitted under the CbCR Safe Harbor. So you can imagine that at the moment taxpayers are rerunning calculations and effectively reconfirming whether they will qualify for the safe harbor. The difference between the safe harbor rules and the standard Pillar 2 rules have also created fears that the safe harbor could be used for avoidance purposes. And in this context, then, the new guidance provides that the transitional CbCR Safe Harbor cannot be used by a taxpayer who has entered into a hybrid arrangement after the 15th of December 2022. This is the release date of the original Safe Harbor guidance. However, the guidance also states that if the country is unable to apply this rule, maybe because of a prohibition on retroactivity, that country could use the date of the 18th of December 2023, which is the date when the current guidance was released.
A recent OECD webinar presented the long-awaited economic impact assessment for the global minimum tax on multinationals. Giorgia, you listened to the OECD's webinar. What were your main takeaways, and do you think this data will be valuable for companies?
Thank you, Ege. So in a new study, the OECD estimated that Pillar 2 will raise between 155 and 192 billion dollars per year globally. This is about between 6.5 and 8% of total corporate income tax revenues globally. Now, where do these gains come from? Partly they come from a higher tax rate in various countries of the inclusive framework, and partly the effect comes from the fact that we will see less profits located in lower tax jurisdictions. According to the OECD, this will happen because a smaller differential between lower and higher tax jurisdictions, with the OECD predicting a substantial fall in this differential, about 50%. But the OECD paper, we need to remember, does not consider the consequences of countries changing their incentive systems as a reaction to Pillar 2. Now, are we looking at large or small gains in tax revenues? We have to say that the revenue gains in the paper are not insignificant, they are meaningful, but if we look at the budget needs of many countries of the inclusive framework, the projected revenue gains will not help much. So there is really a question here on whether Pillar 2 will be enough to take pressure off a continuous reform of the international corporate tax system. And in this context, we need to remember that the OECD results at the moment are slightly larger than what individual countries such as the UK or the Netherlands have estimated in terms of their own revenues coming from Pillar 2. But overall, Ege, this is an important paper that is likely to determine the expectations on how much more taxpayers will pay under Pillar 2 in terms of corporate income tax. But also the study will be a benchmark in the future to understand whether the Pillar 2 reform has been successful from the point of view of governments in terms of raising more revenues. I will conclude by saying that the study does not say if and how economic activity will be reduced in some countries by the higher tax burden introduced by Pillar 2, but the paper focuses purely on revenue estimates. And for an overall assessment of Pillar 2, we should also look at the effect on the economy.
Thank you both for your insights. Before we close, I'd like to point our viewers to one final resource that was created following the adoption of the resolution by the UN General Assembly towards the end of 2023. As previously reported, the resolution concerned establishing an ad hoc intergovernmental committee on international cooperation. The UN now has created a dedicated UN Text Convention website, which is linked in the description of this episode. The website provides preliminary information on next steps of this project, including further details on the process and timing considerations. We'll be back soon with another episode of Global Tax Talk. Until then, be sure to listen to Will Morris on key global tax policy insights for the coming week. Thanks for tuning in so you can stay global tax ready.